Good morning, everyone. Today, we're diving into the world of options trading with a strategy called the short iron butterfly. This strategy is a bit more advanced, but don't worry, we'll break it down step by step. Now, don't let the fancy name scare you. The short iron butterfly is essentially a way to profit from a stock's price staying within a certain range. It's all about making smart bets on whether a stock will move a lot or stay relatively stable. This strategy involves using options, which are financial instruments that give you the right, but not the obligation, to buy or sell a stock at a certain price. Think of it like this. You're betting on a horse race, but instead of picking a single winner, you're betting on a range of horses. In the world of options, this means you're setting up a range of prices where you think the stock will end up. You win if your horse comes in within that range. Similarly, with the short iron butterfly, you profit if the stock price stays within the range you've set. That's essentially what the short iron butterfly does in the stock market. It involves selling a call and a put at the same strike price, while also buying a call at a higher strike price and a put at a lower strike price. This strategy is all about volatility, which is just a fancy word for how much a stock price jumps around. The more volatile the stock, the more it moves up and down. A volatile stock is like a bucking bronco, a stable stock is more like a gentle pony ride. The short iron butterfly is designed to profit from those calmer, more predictable movements. The short iron butterfly thrives on those calmer pony rides. When the stock price stays within the range you've set, you can collect the premium from the options you've sold, making this strategy a potentially profitable one for those who can predict stability in the market. So, how do we make money from this? Well, with the short iron butterfly, we're actually betting that the stock moved too much. We want that gentle pony ride. If the stock price stays within our predicted range, we win. It's a bit like predicting the weather. If you say it'll be sunny with a slight chance of drizzle and you're right, you look like a genius. That's the sweet spot for the short iron butterfly. Of course, there's always a chance the stock price could jump outside our range. That's the risk we take. But remember, we're not betting the farm here. We're carefully calculating our risks and rewards. Now, let's talk about how we actually make money. The short iron butterfly is what's called a capital gains strategy. This means we profit from the difference between what we paid for the options and what we sell them for. Imagine you bought a vintage handbag for a steal at a car boot sale, then sold it for a much higher price online. That's capital gains in a nutshell. With options, we're essentially doing the same thing, buying low and selling high. The key here is that we're not relying on dividends or interest payments. We're making money by being savvy traders and predicting market movements. One of the most important things to remember about the short iron butterfly is that both our potential profits and losses are limited. This strategy is designed to provide a balanced approach to trading, where you can manage your expectations and avoid the extremes of massive gains or devastating losses. By understanding the boundaries of your financial exposure, you can make more informed decisions and trade with greater confidence. That's right. We know exactly how much we stand to gain or lose before we even enter the trade. This predictability is one of the key advantages of the short iron butterfly. It allows traders to plan their strategies with a clear understanding of the potential outcomes. By having a predefined risk-reward ratio, you can align your trades with your overall financial goals and risk tolerance. Think of it like this. You're playing a game of darts, but there's a large circular target board behind the dartboard. This analogy helps to visualize the concept of capped risk and reward. No matter how well or poorly you throw the dart, it will always land within a certain range. This range represents the limits of your potential profit and loss in the short iron butterfly strategy. Even if you miss the bullseye completely, your dart will still land somewhere on that board. This means that even if the market doesn't move exactly as you predicted, your losses are contained within a manageable range. This containment of risk is crucial for maintaining a stable trading portfolio and avoiding unexpected financial shocks. You won't lose more than what you wagered. This assurance provides peace of mind, knowing that your maximum loss is predetermined and won't exceed your initial investment. It allows you to trade with a sense of security, focusing on your strategy rather than worrying about potential catastrophic losses. This limited risk feature makes the short iron butterfly an attractive strategy for many traders, especially those who are just starting out. For beginners, the world of options trading can be intimidating, but strategies like this provide a structured way to learn and grow. It offers a controlled environment where new traders can experiment and build their skills without the fear of losing everything. It allows you to dip your toes into the options trading pool without diving headfirst into the deep end. This gradual approach to trading helps build confidence and understanding, making it easier to transition to more complex strategies in the future. By starting with a strategy that has capped risk and reward, you can develop a solid foundation in options trading and set yourself up for long-term success. Now, let's bring this strategy to life with a real-world example using everyone's favorite electric car company, Tesla. Tesla has been a pioneer in the electric vehicle market, revolutionizing the automotive industry with its innovative technology and sleek designs. The company has not only captured the imagination of car enthusiasts, but also attracted the attention of investors worldwide. Let's say Tesla is trading at $250 per share, and we believe it will stay within a certain range for the next month. This assumption is based on various factors, including market trends, recent news, and overall investor sentiment. By analyzing these elements, we can make an educated guess about the stock's future performance. We could sell a short iron butterfly with a strike price of $250, giving us a range of $240 to $260. This strategy involves selling one call at a higher strike price out of the money and one put at a lower strike price also out of the money, while buying a call at a middle strike at the money and a put at a middle strike price also at the money. The goal is to profit from the stock staying within this range. If Tesla stays within that price range until our options expire, we keep the premium we received when we sold them. This premium acts as our profit, and it can be a lucrative return if the stock behaves as expected. However, it's crucial to monitor the stock's performance and be prepared to adjust our strategy if necessary. However, if Tesla's share price goes haywire and shoots up to $270 or plummets to $230, we'll start to lose money. This is because the stock has moved beyond our profitable range, and the options we sold will start to incur losses. It's a risk we must be aware of when engaging in this strategy. Remember, our maximum loss is capped, but it's still important to understand the risks involved. The cap on our losses provides a safety net, but it doesn't eliminate the potential for financial setbacks. By thoroughly understanding the mechanics of the short iron butterfly and staying informed about market conditions, we can better navigate the complexities of options trading and make more informed decisions. So how do we actually set up this short iron butterfly trade? Well, it involves selling one call option at a higher strike price, out of the money, selling one put option at a lower strike price, also out of the money, buying one call option at the middle strike price at the money, and buying one put option at the middle strike price, also at the money. The two bought options must have the same strike price, and all options must have the same expiration date. Sounds complicated? It can be, but luckily, online trading platforms make it much easier. They often have pre-built short iron butterfly strategies that you can simply select and adjust to your liking. It's crucial to choose your strike prices carefully, taking into account your risk tolerance and your outlook on the underlying stock. Remember, this isn't a get-rich-quick scheme. It requires careful planning and analysis. Now let's talk about how to get out of this trade. The simplest way is to wait until the options expire. If the stock price stays within our predicted range, the options will expire worthless, and we get to keep the premium. However, sometimes things don't go according to plan. If the stock price moves against us, we might want to cut our losses and exit the trade early. We can do this by buying back the options we sold. Exiting a trade early can help us minimize losses, But it's important to remember that we might not get the full premium back. It's all about weighing the potential risks and rewards. Now, let's talk about a secret weapon for short iron butterfly traders, theta. Theta represents time decay, and it's our best friend. Think of it like this. When you buy a piece of fruit, it's fresh and delicious at first, but over time it starts to go bad. Options are similar. As time passes, they lose value, and that's where we profit. The closer we get to the expiration date, the faster the options lose value, and the more money we stand to make. It's like a countdown timer working in our favor. So there you have it, the short iron butterfly options strategy in a nutshell. Remember, it's all about profiting from a stock's volatile movements within a range. This strategy offers capped risk and reward, making it suitable for both novice and experienced traders. However, it's crucial to remember that options trading involves risk, and it's essential to fully understand the strategy before risking your hard-earned money. Happy trading! Thanks for watching and see you next time.